Hello everyone, and welcome back. Today we are going to talk about something that almost nobody discusses in the world of value investing. You see, if you search for Warren Buffett on the internet, 99% of the content is about buying. It's about finding the next Coca-Cola, identifying moats, or holding forever. But the holding forever myth is just that, a myth. The truth is Warren Buffett is one of the most ruthless and disciplined sellers in history. His survival over 60 years isn't just about what he bought. It's about what he sold and, more importantly, when he sold it. Today, we are going to reverse engineer the surprising laws of Buffett's selling. We will look at history from 1969 to the present day to uncover the patterns that predict when the Oracle of Omaha is about to hit the eject button. And trust me, these patterns are frighteningly consistent. Let's dive in. Law number 1, the no-brainer vacuum. The 1969 rule. The first law is what I call the no-brainer vacuum. Many people think Buffett sells stocks because he predicts a market crash. That is technically incorrect. Buffett rarely predicts macroeconomic events. Instead, he looks at what he calls no-brainers, easy, obvious value. When those disappear, he doesn't just sit there. He leaves the casino entirely. The case study, 1969 partnership dissolution. Let's go back to 1969. The U.S. stock market was in a go-go era. Tech stocks, then called tronics, were soaring. Everyone was making money. But Buffett did something shocking. He wrote a letter to his partners and effectively said, "I can no longer find any deals. The market is too speculative. I am closing the partnership." He didn't just sell a few stocks. He liquidated the entire partnership and returned the cash to his investors. He literally fired himself because the game had become too easy for others and too hard for a disciplined investor. The outcome, 2 years later, in 1973 to 1974, the market collapsed, losing nearly 50% of its value. Buffett looked like a genius, but he wasn't predicting the crash date. He was simply reacting to the absence of value. The lesson for you: when you look at the market and cannot find a single company that makes sense mathematically, that is a sell signal. Buffett would rather sit in cash for years than play a game he doesn't understand. This brings us to a modern parallel. Modern application. In 2024 and 2025, Berkshire Hathaway accumulated a record cash pile, over $300 billion. He sold significant stakes in Apple and Bank of America. Why? Because the Buffett indicator, the ratio of the total stock market to GDP, hit record highs, crossing 200%. The no-brainers had vanished, just like in 1969. Law number 2, the Broken Thesis, the airline pivot. The second law is the Broken Thesis. This is perhaps the hardest lesson for emotional investors to learn. Buffett is famous for saying his holding period is forever. But forever has a condition. The economics of the business must remain favorable. If the fundamental economic reality changes, forever ends today. The case study, the 2020 airline exit. In 2016, Buffett invested heavily in the 4 major U.S. airlines: Delta, United, American, and Southwest. His thesis was that the industry had consolidated and would be a cash-generating machine for decades. Then, COVID-19 hit in 2020. Air travel stopped. Now, a typical amateur investor might say, "The stock is down 60%. I should hold and wait for it to bounce back. It's just a virus." What did Buffett do? He sold everything. Every single share. In April 2020, near the bottom of the market, he dumped his entire airline portfolio at a loss. Why? He explained that the world has changed for airlines. The industry would need to borrow billions just to survive, meaning future profits would go to paying off debt, not to shareholders. The thesis that airlines were cash machines was broken. The lesson for you: when the reason you bought a stock is no longer true, you must sell. Do not look at the price you paid. The market does not care what you paid. If the business is fundamentally damaged, you take the loss and move on. Law number 3, the Cockroach Theory, management integrity. Law number 3 is my personal favorite, the Cockroach Theory. There's a saying in finance: there is never just one cockroach in the kitchen. If you find one problem with management's integrity, there are likely dozens more hidden behind the walls. The case study, Freddie Mac in 2000. Most people know Buffett made a fortune in 2008, but they forget he saved himself by selling before the crisis. In the late 90s, Berkshire owned a massive stake in Freddie Mac, the mortgage giant. It was a perfect business. But around 2000, nearly 8 years before the housing crisis, Buffett sold almost all of it. Why? He noticed that Freddie Mac's management was obsessed with smoothing their quarterly earnings. They were trying to report steady, double-digit growth every single quarter to please Wall Street. Buffett knew that real financial businesses are volatile. You cannot have smooth earnings in a volatile world unless you're manipulating the numbers. He saw one cockroach, accounting manipulation, and decided to sell. The outcome? In 2008, Freddie Mac collapsed and was taken over by the government. Shareholders were wiped out. Buffett was long gone. The case study, Tesco in 2014, we saw this again with the British supermarket Tesco in 2014. Buffett owned a large stake. When the accounting scandal broke revealing they had overstated profits, Buffett admitted, "I made a huge mistake," and sold the rest of his position. He does not tolerate management that plays fast and loose with numbers. The lesson for you: if a CEO lies to you about the small things, they will lie to you about the big things. Sell at the first sign of dishonesty. Law number 4, better early than late, the valuation exit. Finally, law number 4, better a year early than a minute late. There's a misconception that you should sell at the top. Buffett never sells at the top. He almost always sells too early, leaving money on the table. And he's perfectly fine with that. The case study, PetroChina in 2007. In 2003, Buffett bought a massive stake in PetroChina. The company was undervalued and paid a great dividend. By 2007, the stock had risen significantly. The market was getting hot. Buffett sold his entire stake in 2007. The reaction: investors criticized him. After he sold, the stock continued to go up. It looked like he had made a mistake. The aftermath: shortly after, the global financial crisis hit and oil prices crashed. PetroChina shares plummeted. If he had waited, he would have lost billions of dollars in profit. Buffett's philosophy is simple: don't be greedy. If a stock reaches its intrinsic value, or if it becomes dangerously overvalued, sell it. Let someone else try to squeeze the last 10% out of the bubble. Summary and conclusion. So, let's summarize the 4 laws of Buffett selling for your notes. The no-brainer vacuum. If you can't find value, cash is a valid position. Don't force a trade. Example, 1969-2024. The Broken Thesis. If the economic reality of the business changes permanently, sell immediately, regardless of the loss. Example, Airlines 2020. The Cockroach Theory. If management focuses on pleasing Wall Street over honest reporting, run away. Example, Freddie Mac 2000. Leave the last penny. It is better to sell early on valuation than to hold on for the crash. Example, PetroChina 2007. Closing thought. The surprising pattern here is that Buffett is not an emotional holder. He is a cold, rational calculator. He is willing to look stupid for selling airlines at the bottom, and he is willing to look out of touch for sitting on cash during a bull market. As you build your own portfolios, remember this: buying makes you rich, but selling keeps you rich. Thank you for listening. I'll see you in the next video.